On April 7, 2025, China took an unexpected step that could shake global markets, but almost no one noticed it right away. Everything happened so quietly that it seemed like just a minor internal measure. China secretly ordered state banks to stop buying US dollars. No statements, no official notifications, just a sharp policy shift capable of changing the rules of the game. This happened just a few days after the US hit China with new tariffs and a week after a sharp rise in US Treasury yields. At first glance, it might have seemed like a minor detail, but in reality, it was a direct challenge to the dollar, the currency that for decades has been the cornerstone of global trade. What does this mean for the future of the global economy? But before we get into the details, don't forget to subscribe to the channel and turn on notifications to stay up to date with all the latest events. So China's decision to stop buying dollars is neither an accident nor a gesture of protest. It is a carefully calculated move as part of a larger strategy to break free from dependence on the American currency. The People's Bank has made it clear this is not a symbolic gesture, but a practical action. The goal is to stop the influx of dollars into the market and gradually shift transactions to yuan. And the timing is no coincidence. All of this happened against the backdrop of new American tariffs and a sharp spike in US government bond yields. For decades, the dollar has been the backbone of global trade, but Beijing has shown that it is ready to challenge the very center of the global financial system. As of February 2025, China's foreign currency reserves amounted to about $3.23 trillion, 20 billion higher than the January level. These reserves are the big foundation of the country's economic stability and one of its main levers of influence on global markets. A significant portion of them is held in dollar-denominated assets, especially in US Treasury bonds. According to various estimates, Beijing holds between 761 billion and 1.2 trillion. The difference is explained by the fact that part of the assets is held through third countries, for example, through entities in Belgium. This means that China's actual presence in US debt may be much greater than what is officially acknowledged. On the one hand, such investments provide China with flexibility, high liquidity, convenience in settlements, and protection from market shocks. On the other hand, it is a vulnerability, a dependence on the policies of the Federal Reserve and the dollar exchange rate. That is why in recent years, Beijing has accelerated diversification. One example is the growth of gold reserves, which by November 2024 reached 73 million ounces. But for China, foreign currency reserves are not just about the economy. They are also a geopolitical weapon. Beijing can use its assets, both dollar and yuan, as a lever of pressure. And more experts are warning this is not a minor change, but the beginning of a new era. According to Wall Street data, in just the first quarter of 2025, foreign investments in US government bonds decreased by $67 billion. The main sellers were China and Japan. This is no longer just a portfolio adjustment, it's a signal. If other countries follow China's example, the dollar could begin to lose its global role. The world stands on the threshold of a new financial reality, and perhaps we have just witnessed the first step toward its launch. Just 2 days after China stopped buying dollars, Spain also made a sharp economic turn. It signed a large-scale agreement with China, one of the biggest Chinese investments in Spain since 2005. The deal covers key sectors: logistics, green energy, scientific research, and development. As part of the agreement, Chinese companies receive special access to important infrastructure, including electric vehicle manufacturing plants. At first glance, it may seem like just a profitable deal. But in reality, it's a sign Spain is reconsidering its political and economic priorities. It has decided to strengthen its ties with China rather than rely on the US or even the European Union. In fact, this deal completely bypasses both the EU and NATO. The signing of the agreement took place shortly after the US imposed tariffs on European electric vehicles, which were also aimed at Chinese subsidies repackaged through Europe. Caught between the blow from these tariffs and the opportunity to grow its own industry, Spain seized the chance and moved closer to Beijing, and this could mark the beginning of a larger shift in Europe. If Spain, a key member of the EU and NATO, is willing to take such a step, other European countries may follow suit. This could lead to a weakening of traditional Western alliances and change the nature of relations between Europe and China. Moreover, it could also impact NATO's cohesion. If other EU countries start entering into similar agreements with China, this could split the European Union and weaken the political and economic influence of NATO. Spain's move is a clear signal. Europe has begun to reconsider its long-standing ties with the United States, and the consequences of this step could be extremely serious, both for the future of European politics and for international alliances as a whole. We need to understand why this trade war is so difficult to stop and how it has reached such a critical level in the first place. In April 2025, the trade war between the US and China escalated to a new level. President Trump's administration imposed yet another wave of tariffs on Chinese goods, including technology, automobiles, and semiconductors, and this happened at an extremely tense moment. The yield on US Treasury bonds spiked sharply, which became an alarming signal for financial markets. The rise in yields, combined with a decline in foreign investors' interest in US government debt, made it clear the US economy is facing serious problems. The new tariffs only increased the pressure, demonstrating that the US is aiming to economically isolate China. But China did not back down. Despite these US attempts to restrict trade, Chinese exports to global South countries grew significantly. Beijing found new sales routes through Vietnam, Cambodia, Mexico, and other countries. These workarounds allowed China to continue exporting while avoiding direct exposure to American tariffs. This once again proves that the modern trading system is changing, and tariffs alone are no longer enough to stop China's economic growth. China's ability to redirect shipments through third countries is a vivid example of how traditional tariffs are losing their effectiveness. The World Trade Organization, WTO, has already taken note of the sharp increase in the volume of Chinese goods passing through other countries. This means that American tariffs have not stopped Chinese exports. They have only made the routes more complicated and less transparent. While the US imposes barriers, China adapts, and the global trade structure becomes increasingly fragmented. The US is destroying traditional trade channels, but is not achieving the desired result. This is precisely where Beijing's new strategy is manifesting itself. Despite Washington's efforts, the Chinese economy continues to grow, finding workarounds. This raises the question, how effective are tariffs as a tool of economic pressure at all? While China successfully circumvents American measures, the world is witnessing a transformation of the entire global trade system, and these changes will have long-term consequences. Countries are forced to adapt to an increasingly complex and interconnected trading reality. One of the most striking signals in recent weeks is the rapid advance of the Chinese automotive giant BYD. Despite all the sanctions and restrictions, the company announced the construction of a large-scale industrial cluster in Valencia, Spain, which will include an electric vehicle plant and a gigafactory for lithium iron phosphate batteries. These batteries are cheaper and safer than most Western counterparts. But all this is not just business. Through BYD, China is expanding its political influence in Europe. Spain, in need of jobs and economic growth, gladly welcomed Chinese capital. The government quickly approved the project, hoping it would help the country become a leader in Europe's transition to green energy. Thus, Spain is turning into an important ally of China, right in the heart of the European Union. At first glance, this seems like a mutually beneficial partnership, but in reality, it is drawing Europe into dependence on Chinese industry. Although the cars will be manufactured in Spain, they are directly dependent on Chinese technology, raw materials, and supplies. China controls key components, lithium, cobalt, rare earth metals, and processes them domestically. While Europe talks about energy autonomy, the BYD project only increases its vulnerability. This is causing concern in the West as relations between the US and China become more strained. Washington is trying to sever economic ties with Beijing. Spain, on the other hand, is moving closer to China, reaping short-term benefits. But at what cost in the long run? In Germany and France, which have already suffered from American tariffs on cars, there is growing concern as they watch Spain deepen its cooperation with Beijing. This move demonstrates just how divided Europe is becoming. Those who were at the origins of EU unity, like Germany and France, are losing influence, while Eastern and Southern European countries such as Hungary, Greece, and Bulgaria are openly demonstrating their willingness to cooperate with China, even if it goes against the policies of Brussels and Washington. But it's not just about Spain and not even just about the EU. This is a story about how China is changing the world without firing a single shot. Through major investments, smart strategic planning and foresight, China is building its influence right in the heart of Europe. It doesn't need troops or ships. It's enough to build a factory, set up logistics, and invest money where others cannot or simply do not want to. Many are now asking whether this is truly a threat. For many years, and with billions of dollars, China has been investing in the development of giants like BYD. It dominates the markets for cobalt, lithium, graphite, and even battery recycling. This control gives Beijing a powerful lever. It can manage prices, control export volumes, and exert political pressure. Unlike Western companies, BYD is closely connected to the Chinese state. It operates not only for profit but also embodies Beijing's strategic interests. So when BYD invests in Spain, it's not just a commercial project, it's part of a state program to expand influence. And all of this is happening against the backdrop of a crisis in the West. In the US, there is political instability and deindustrialization. In the EU, there is disunity and the consequences of harsh austerity. For countries like Spain, Chinese money seems like salvation, but this help could turn into a loss of independence. As the economy becomes more closely tied to China, uncomfortable questions arise. For example, will European countries in the future criticize Beijing over Taiwan or human rights? Or will they prefer to remain silent for the sake of contracts and jobs? And China is not stopping there. In April, the media reported that BYD is considering building new factories in Poland and Hungary. These countries are desperately in need of jobs and will most likely welcome Chinese investment with open arms. But Western intelligence agencies are sounding the alarm. A leak from a NATO report revealed that the existing risk that such factories could be used for espionage, data collection, or even military purposes if a conflict breaks out between China and the West. And this is not just fantasy. Previously, surveillance systems have already been found in telecommunications equipment, so why not do the same thing with battery platforms? In the United States, concern is turning into open discontent. Even under Biden, allies were warned not to rely too heavily on China, especially in such critically important sectors as energy and automotive manufacturing. But in 2025, with Trump's return to the White House, this concern turned into anger. Washington saw the BYD Spain deal as a stab in the back. There is already talk of imposing tariffs on Spanish cars with Chinese components. This could further deepen the rift between Europe and the United States. The trade war is escalating into a geopolitical one. Alliances are cracking, old rules are collapsing, and new blocs are forming. Right before our eyes, the map of global influence is being redrawn. And now the main question is whether the West will stand as a unified bloc or if China will split it from within through economics, technology, and logistics. If you want to keep following this great game, don't forget to subscribe to the channel and turn on notifications because the next moves by the major players could change everything. Thank you for watching and see you in the next video. Goodbye everyone.